Selling into strength was one of the hardest things for me to learn, and it's something that a lot of people struggle with too. The reason why is because when you're in a trade and the trade is working, you don't want to part ways with it, right? Like, it's doing everything that you wanted it to do. You bought it because you wanted it to go up, and guess what it's doing? You bought it and it went up. So the last thing that you want to do is sell this, right? Like, we're often taught that when something is working, don't fix it, right? Like, wow, that's something that just dawned on me too, right? Like all these things that we learn in other parts of life, or things that we may hear that serves us in other ways, how that could seep into trading, man. Like, if it's not broke, don't fix it. Well, part of your trading or your trading system has to have ways for the market to pay you. You want to give it multiple ways for it to pay you, and one of the ways is going to be to take profits along the way. So I came up with a rule for myself that when I have multiples of the amount that I've risked, right? So let's say, very simple trade, I found a trade where I'm going to risk $1 and I'm hoping to make $4 on this trade, right? So it's a 4-to-1 reward to risk. Fantastic. So that means that when I get to 1R, right? Like, so I've made $1 on this trade, take just a little bit out, right? Like, maybe I'll take 10% out, maybe I'll take 15% out, whatever it is, and I'll come up with that part of the plan, like, as I'm coming up with the trading plan and understanding how the market's moving, understanding how the trade is moving, predefined for that. But I'm going to start to take off a little bit when it hits 1 times my risk. Made $1, great. Now it's up to 2, right? 2R. $2 on this trade, great. Take a little bit more off. 3, take a little bit more off. 4, take a little bit more off. And then, like, I'm still had like a bit when I do hit the ultimate profit target, right? Because we want to let our winners run for as long as possible. That doesn't mean that we should not take gains along the way. So I'm selling into strength when I'm hitting those R multiples. Then the next thing that I'm doing, right, like, because we want to have more than just how we're going to sell into strength, is also how are we going to scale out on the way down. So I think that having trailing stops is important as well. Something that is going to move with price as it's going up. There's a lot of different ways to do it too, right? Like, if you're not a fan of setting a percentage from the high, right? Like, so let's say you're in a $100 stock, it moves up 5%, then you have like a 5% trailing stop that now your stop is at 100. I'm not a big fan of that either. What I'm a bigger fan of is using moving averages as trailing stops. So I'll look at different moving averages, 5 EMA, 10 EMA, 21 EMA. Why those? Those were the ones that Ed Seykota used, Market Wizard. Go read Jack Schwager's book, Market Wizard. It's a fantastic book. Anyway, so I'll set my trailing stops based off of those moving averages. And again, not selling everything at once. Just as the stock that I'm in starts to lose momentum, starts to close below those moving averages, sell a little bit. Maybe it tests another one and then bounces and then continues back on higher. Great. That part of the idea too, like, you don't need to make all or none decisions. It's scaling out progressively rather than all at once, so that way you could capture more of the move. And not only that, you're giving the market multiple ways to pay you. And that's why we're doing this, right? For the market to pay us in one way or another. Hopefully more.